Monday, March 9th, 1:03 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Hope you're having a good day. Hope you had a good weekend. Going to go over the energy sector, commodities, energy sector, and options. You can trade in the equity market, trade in the futures market. Give you some insight. I have positions on bullish positions. They have huge gains, not profits, because I haven't closed them all yet. And I'll explain why briefly, and I'll show you why. Give you some more insight. My bullish positions are on crude oil and natural gas with options, advanced option strategies on the options on stock ETFs. Those stock ETFs are managed by companies that buy the futures contracts and then offer the equity and then have options on them. That's a lot of information. Some people are totally clueless on that. Some people understand some of it. Some people understand a lot more of that. Baby steps. There's a learning curve to get over. Deal with it. Looking at two charts, candlestick charts. Each chart is 1 year of history. Each candle represents a day. U.S. stock market still open. Doesn't close till 4 p.m. New York time. The left is the stock ETF for natural gas. That symbol's uniform November Golf. And the right is the stock ETF for crude oil, uniform Sierra Oscar. On the top left of each chart, such as on the left here, that's the current price for natural gas, $12.46. And on the grid on the right, USO crude oil, $114. Real basics here. Stock market. If you buy a stock, you're bullish and anticipating the stock to go up in value. Think about it. The markets, the exchanges, the brokers refer to that position as long. That's a key word, buzzword, long. Remember that. I'm going to test you. So when you hear that phrase, long the market, that means you're bullish. Positions, that means you're in a position. Doesn't say the size of the position, you're in a position. I'm bullish. I'm in positions, natural gas, crude oil, two different assets. I'm not in the stock positions. I'm the option positions. Those contracts have expiration days. They're derivatives. I've been in them for several weeks before the current battle of the current war. That being said, I've been bullish both of these for months. I have key levels that I look for to take my entry. Right now, those positions, right now, the stocks prices for me are too extended for me to want to reload more positions on these. I'm looking for them to pull back to key levels that I'll take positions on. I'll try to take positions. Yep. Again, each one's daily chart, a 1 year chart. So let's go a little bit more. I want to show you. Now we're looking at the level one. All brokers offer level one. That's real basic. So the stock symbol on the top left, that's the price, 114. You can see obviously it's moving because the market's open. Here's the bid and ask. Again, this is all part of level one. The last price, the change. So the bid and ask. I choose and I prefer stocks, options on stocks that are tight spreads. The tight spread between the bid and the ask, the spread, the difference. I prefer 1 penny. The wider it is, good for the bookie, bad for you. Okay, let's just round this off. Say here, it's 114. And say here, it's 113. That'd be $1 wide. So if you be buying on the ask and then immediately want to sell it on the bid, well, again, the $1 wide, you'd be paying over market price and you would have to have to have it go up at least above $1 from the price you bought it at. So I rather have it a tight spread, 1 penny. So again, I don't have to wait for it to go up at least $1 above my price. Doesn't mean it will. Yep. Got it? Again, the spread between the bid and the ask. Different financial exchanges, different financial assets. They all have bid and asks, and they're different wide. Some that deals with the time of the day, time of the year, such as liquidity too. See, here's the volume. So crude oil, it's been around before I was born. I expect it to be still here when I'm gone. Not like Sears or Kmart or GameStop. Just give you some example. When companies, stocks fall out of favor, you see often the liquidity dries up and the spreads get worse. Again, this is a stock ETF on a commodity. It's not a retail store. It's not Amazon. It's not Tesla. Nope. Okay. Just to show you that. Prices are moving really fast, aren't they? Crude oil. Now let's look at the stock ETF for natural gas. Again, $12.49, $12.50, one penny wide, high liquidity over 20 million shares. Again, tight spread. So now I want to show you the option chain. Let's look for the nearest monthly in 45 days. Okay, I don't want to go the weekly. I want to show you the monthly. Right here, 17 April. It's the nearest monthly that expires third Friday of the month. And again, the underlying price, $12.47. Let me close part of this. Let's just do it simple. There we go. Again, the current stock price, $12.47. I want to go the nearest strike. The nearest strike would be nearest that price. So the nearest price, I'll be looking for if there's a half. Nope, there's no half. There's no $12.50. So obviously it's below $12.50. So again, the nearest one would be 12, the strike of 12. Look at the spread, the bid and the ask. That's wide. That's not good. Okay. On the stock ETF, look at the bid and ask. Very tight. It's like almost 1 penny. Yep. So now let's get in the 17 April. Let's go take this and look at the weekly. Expires 24 April. Same strike. Actually, no, they got 11.5. Look at the bid and ask. Huge spread, 60-80. That's good for the market maker, but not good for the retail. 12. Now there's ways to work around this. I've shared that on other videos. Doesn't mean you're going to get a fill because you get good money management. You're going to be solid at what you're willing to pay, but there are ways to work around it. I work around it, and often I get better fills than being taken advantage of. Let's go to a shorter duration. Let's go put USO back on here. And we'll start going to charts to show you. Okay, USO, the nearest monthly that expires 45 days, right there, 17 April, open it up. Again, the underlying $114.75. Go to the nearest strike. The nearest strike is 115. Again, the stock, 114.68, so it's above midpoint. Well, mid or half. It's above 114.50, so it's closer to 115 than it is 114. So I'll look at the 115 strike right there. Look at the spread. 1590, 1730, huge spread. And look at the stock up here, stock ETF spread, 1 penny. 1 penny. Now, if I go here on the call side, again, let's go look at the 115 strike here, and we'll look at the bid and ask. Huge spread. Not good. Well, part of this dynamic pricing right now is because of the extreme volatility. Not all assets are this bad, and some assets are really bad because the issue going on, the battle, the war. Come on now. This is a commodity. Commodities. Good times, bad times. Now, that being said, we're just looking here. Show you one more. Go to 115 strike on crude oil. Look, 1610, 1885. Huge spread on the put side, and go to the call side. Big difference. Good for the bookie. Unless you know how to work those. And the other point is, I want to show you here. USO, 114. If you're bullish and want to buy a call option, say you want to buy a call option out of the money is above the stock price. The stock price, again, 114.65, 114.61. So if I buy out of the money call option, it would be a strike higher than that. That would be the 115. Call options are on this side. If I'm buying it, you're buying on the ask, but I don't have to take that price. I could try to get filled at the bid price. Again, if I'm buying it, yes, I'm buying at the ask, but I can negotiate that bid. So I can negotiate that price and try to get the ask price to fill me at the bid. And you see that price, 17.75? That's not $17.75. Nope. Each contract, if you understand equity options, stock options, they're 100 shares. 100 shares. Do the math. Do the math. 100 shares times 1775. That was a good year, right? $1,775. That's how much it would cost. $1,775 for the contract. Yep. And not following me, I'll do it on something smaller. UNG. UNG, price $12.47. Let's look at the 12 put here and 121. 100 shares times 121. That costs $121 if you buy the put. If you go here on the ask, if you go here on the call, if you want to buy that 12 strike, 185. Now let's go to the charts. I told you my thought is my bias is bullish, these commodities. But for me, I'm not buying them here because they're not at the price range I want to buy. But I have positions on, and they've been very hard to close them because dynamic pricing is not at the good mid. Still got a few weeks for a few of them till they expire. Crude oil, 20-year history in each chart is a monthly. Sorry, 20 years of history here, data, 20 years, and each candle's a month. Look at the high, 2008. We're not there. And look at the low, 2020. We're not there. The current trend is up. Look on the right. Current trend is up. So this one monthly candle, again, we're only 9 days into this month. We really took out the high of last year, took out the high of 2024. We took out the high of 2023. Huge trading range. Again, we're not even done. We're only 9 days into the monthly candle. What else could happen? Holy moly. Let's go to the lower time frame. Now we're looking at 5-year chart. Each candle's a week. That red candle represents this new week. That red candle only opens Sunday night. Yep. So the complete trading day of today is not done yet because it's futures. Doesn't close to 5. That's a huge trading range for one day. For the weekly candle. That's not going to be done till close of Friday. Except we broke the high, 2023. Wow. Yeah, very overextended. Good job out of you if you did the profits already, if you had gains, and if you closed them up there. Daily chart. This candle, green candle, was Friday, and this candle's been the one since Sunday. It's not done yet. There's a gap down here. Hasn't even been tested yet. And here's the intraday 4-hour candle. The current candle just started after 1 p.m. So this red candle here, that just got done at 1 p.m. It's 4 hours. That was Sunday night. We gapped up. See, that was the close right there, that yellow candle. That was the close of Friday. Sunday evening when the futures opened, it gapped up, ran up, high of $119.48. Since then, the momentum is trending down. Good for me, since I want to reload more positions. When it comes down to my sweet spot, I'll be looking for that single, and then the entry has not occurred yet. Now let's go to the chart of natural gas. $20-year chart, each candle's a month, natural gas. Look at the top left. That was a high of 2008 and bottom 2020. Again, we're inside the range of the high and low with crude oil, natural gas, both commodities, both energy commodities, both fossil fuels. Here's the high of this year. Here's the low this year on the monthly. Big difference that what crude oil is doing. Current month, we haven't even taken out the high or low of last month. It's been less volatile this month than crude oil. Weekly chart, 5 years. Look at that. We already took out the high of last week. Trend is up. Higher high, higher low. And daily chart, natural gas. That yellow candle, it closed like that. Then the next day, it gapped down. So that red candle, gap down. But this gap hasn't been filled yet. Show you some more. That green candle, when that closed the next day, gap down. That gap has not been filled yet. Let's zoom in some more. This red candle, the next day, gap down. And that gap got filled today. Again, the candle doesn't close. Doesn't complete. This is a daily candle till the close of the day, 5 p.m. The point is, the gap got filled. I am bullish bias here. That is one of my setups, and also the swing point right here. We broke above that swing point. So it broke above a swing point, and we filled the gap. That was my setup, one of my setups. So now is the second part. The second part is a single. I'm waiting for a single. And when that occurs, then I'll set my prices for entry. Good money management, good strategies. Got it. Let's take this intraday on the 4-hour. Here we are on the 4-hour of crude oil. 4-hour of natural gas. Far left, that was that gap. Several weeks ago, we gapped down, and overnight, we filled that gap. This is all overnight. So fill that gap, ran a little higher, and then reversed. So now, since we filled that gap, I'm going to remove that orange line. And also, this right here, that swing point was major resistance from the prior times. You saw that red line right there. We never made it up there. We never made it up there. Overnight, we went up there and closed above it. So that's not valid anymore. That. And look at this. Again, the yellow candle is the new one, but the red one just before it got done at 1 p.m. Huge impulse move down and broke and closed below this imbalance area, tested this imbalance area. Yep, I'm in a sweet spot. Again, my setup's already occurred. I'm looking for singles and I'm looking for entries. So that being said, let's put these side by side. I showed you the side by side for the stock ETFs, but I want to show you side by side on the futures. So you get let's just say, more insight on the comparison. So the left is the natural gas futures, and to the right is the crude oil futures. I want to put them both on a 1 year. I'm going to finish it off here. Oops. So they're both 1 year charts, futures markets, natural gas, left, crude oil on the right. Notice some divergencies here. One's inside, I showed you the range of some prior years, and the other one's breaking highs. Both commodities, both energy, both fossil fuel, volatility. I'm bullish both. I'm looking for key levels to take entry using advanced option strategies that pay me a debit. Sorry, pay me a credit. Yep. Thank you as always. Spend just a little time with me. That's it for the video. Thank you for watching.